Hi, everyone. Welcome to the Canadian Tech Accelerator kickoff day. We have Stewart on the line as well. I apologize for the logistical issues that we're having. Wanted to first congratulate the 8 companies that have been selected to participate in this fall 2021 program focused on go-to-market. You have made it amongst the list of, I believe, 50 companies that have applied for this program for this particular track. So I wanted to give you guys a round of applause for making it to this program. Just wanted to, get you guys familiarized with some of the internal people at Trade Commissioner Service. Rana Sarkar, who is the head of mission for Silicon Valley, San Francisco Silicon Valley. Myself, I am the CTA program manager, and Scott, who is the head of office in Palo Alto. He also manages our network of VCs in the Silicon Valley, and you'll be able to work with him on the VC program side of things. Just wanted to let you know that, in case you don't know, that the CTA program is one of the numerous programs provided by the Trade Commissioner Service, whose sole mission is to advance the Canadian economy internationally, but also generate some investment in Canada as well. We've been around for 125 years, and we serve approximately 16,000 clients per year. You can also see that we are a global organization with 161 offices located around the world, and 6 Canadian offices in several parts of Canada. Just to give you a quick snapshot of the CTA program, we've been around for 8 years. So since 2013, the Canadian Tech Accelerator has generated over $238 million worth of revenue reported, over 1,000 partnership agreements, and $6 million of capital raised throughout our program. I'm pretty sure that these numbers are a little bit lower than what the real numbers are, since we're having a hard time tracking these numbers, and I encourage companies that are participating in this program to stay close with us and report any form of successes that are generated through these programs. So what's in store for this program? This is my 3rd iteration of the CTA program, and we have noticed through the past programs that companies are still having a hard time raising capital through our program. And the most notorious reason is that they are a little bit too early, haven't generated enough traction in the Silicon Valley or in the US in general. So I decided to split the program into 2 different tracks. One that is primarily focused on go-to-market, which will help companies execute on their go-to-market strategies that would then qualify them for the next program in the spring that would be heavily focused on VC fundraising. The program context is very simple. We have some group sessions on various aspects of go-to-market, and I have assembled a team of experts that were curated through my extensive effort. I went through about 25 advisors that I interviewed on various aspects of their expertise, and put together a team of advisors that will be helping you execute on those go-to-market strategies. So the group sessions you will have almost every week. Then you will get a chance to work one-on-one with an advisor and that will be focused primarily on defining your ICPs, identifying your competition, and optimizing your sales channel. You'll get the chance to work with me bi-weekly also to make sure that you're on track and that we are helping you support your goals. This is a team of advisors that I have put together. So we have Stewart on the line, who is the main, the VC advisor. He will be helping you, kickstart your fundraising effort as part of this program, but also in the next program. Rick, Leslie, Erica, Francesca, Blaine, and Sean will be also supporting you. So how will we work together? We are expecting you to participate in all of the group sessions. Those are generally focused on general knowledge on go-to-market in the Silicon Valley. This session will be complemented by, we call it weekly homework. Those are some of the work that you will have to do as part of the program. It is not unnecessary homework. Those are the work that have been thought through to help you make progress and achieve your goals as part of this program. So we'll be using Slack for communication. I'll create a channel and invite you all as part of this group. The Google Calendar will be used for scheduling. You'll be sent some calendar invites to all of the sessions. If you have any questions, feel free to raise your hand, and I can give you the mic. Mike Klein, would you are you still raising your hand or no? Any questions, anyone?
Also, there's a question and answer tab as well that they can access to put in questions. So there's both the chat and the Q&A.
Yeah. Oh yeah, that's right. There's a chat.
No one's put any questions in that I've seen, but that's just an option for you all. Well, if Ron is not here, I'm going to steal his time.
Go for it.
Okay.
Should I start the share now?
Sure.
Right.
So first of all, while I'm pulling up my slides, I want to thank you all very much for taking the time to spend with us today. 90 minutes, 2 hours. This is a significant amount of time in the life of any startup, of any company. Really appreciate the CEOs and the founders and the C-suite folks who are participating today in this program. My hope is that we will impart both a setting of expectation and also ways for me personally, ways that you can truly be successful and get the most out of your efforts penetrating Silicon Valley. So briefly about myself, I'm with a venture fund called Viaduct Ventures. We focus on late seed through Series B companies. We are a more generalist. When you look at our portfolio, we very much focus around B2B software, some enterprise, excuse me, as well as some fintech. We do have a generalist approach. Our mandate allows us to go a bit broader, but you'll see the bulk of our activities are very much in the B2B enterprise space. I personally, in addition to Viaduct Ventures, I had the latitude to continue to operate an organization I founded, 16 years ago, called VC PERT, and that focuses on, it's an advisory fund, which focuses on helping companies navigate capital raises, exits, and also doing successful interactions with corporates. I both work with large corporates in terms of setting up venture funds, corporate venture funds, and also looking at ways to try and monetize innovation. There's more to that, but I'll just keep it at that. And then what kicked all of this off for me, so briefly about myself, I've had the pleasure, and I mean that, insanity, and I mean that, of being on both the buy and the ask and the sell side of the equation. I started off on being recruited into a startup all the way back in the 90s, fell in love with it. It truly is an addiction, isn't it? And proceeded to go through a series of startups, learn a heck of a lot, And at that time, we recognized what we thought was a inefficiency in the market that people weren't talking. And there wasn't an opportunity for entrepreneurs, there wasn't an opportunity for angels, and there wasn't an opportunity for venture capitalists to have meaningful conversations. And we thought, hey, if we can just get people together, treat them like the round table, one for all and all for one, and share radars, it would be tremendously beneficial. Turns out that thesis bears fruit. And that thesis bears fruit because it is actually against the norm. The norm is that there is a distinction between angels and VCs. There is a distinction and a barrier between VCs and corporates. And while that has blended, thankfully, that has blended much better than it has back in 2000 and 2001, it's still there. And there's some reason for it. And in our next conversation together, we may choose to go in depth into that. But what we did, that in turn is what led to the formation of the Venture Capital Roundtable, which still exists today. While we sold that business off and it's being run still actively in the Valley, and we're excited to see what they're doing and how they continue to evolve it. But that essentially is what propelled me into the buy side as well as the ask side. All right, let's see if it's going to allow me to change slides. Excellent. So I'm going to go in reverse order. I know we don't have an opportunity for you to speak, although please do raise your hand. And Terry, I hope you will allow people to cut me off at any time. This is not meant to be a lecture. This is definitely meant to be a dialogue. Pre-COVID, we would all be meeting together and we would be dialoguing, me in front and then doing roundtables. I miss that very much. Zoom has taken us a long way, but that interaction, being able to get the feel and the context of your business, being able to get a feel in the context of what you're trying to succeed is I think, very important. So I did have the opportunity to see aspects of your applications into the program. And I'm going to try on a generalistic approach. I'm going to try and weave my understanding of where your respective companies are and as a group to shape what we're doing today. Other thing, I just want a full disclosure. I have an investor bias, of course. It's what I've been doing primarily for the last 20 years. But the purposes of today is very much go to market. And it may sound like they're somewhat at odds with each other, not. And that is because, and this goes back to what Terry has done with his program. And that is your go to market success, your commercial success is a key driver, if not the key driver, in terms of making you attractive to investors. That investor interaction is going to lead to capital infusion into your business. But let's be honest, why is the capital being put into your business? Because it's an expectation of being a material accelerant into your next stage of go-to-market, your next stage of commercial activity, your next stage into scaling. So you'll see a constant virtuous circle of the more success we have on the commercial side, the more metrics we have to demonstrate that commercial and that market success, the more attractive we are to investors, which allows us to put more money, capture more money in terms of institutional capital in the business, which in turn drives more pressure for you to then continue to execute that growth. So let's talk about some topics that we're going to look to cover today. By the way, I do not have the chat. So if there's stuff coming, clue me in, Terry, because I don't see it.
No questions so far. We're good.
So let's talk about succeeding. So what we'll look to do today is talk about succeeding in Silicon Valley and how innovation, risk, and funding flows are going to shape, and you may already be experiencing this, shape the customers, the partners, and the capital sources that you're already looking to reach out to, and especially when you come to the Valley. We'll really briefly talk about how VCs work. And we're also, I think, even more so going to want to talk about the critical impact and the theory of large markets. So here's the punchline. Venture capitalists are looking for you to access and disrupt large markets, which in turn is going to generate real premiums into your business that's going to get the type of returns that would lead to an IPO or lead to a very high dollar M&A. Corporate partners, large partners that you work with, large customers actually have a similar bias. So we'll get that more in depth, but the foreshadowing here is if you're going to work with IBM, if you're going to sell into Samsung, if you're going to partner with E&Y, as much as you know your product is going to have a direct impact on customers, these three example customers, partners, and facilitators are looking at you from a theory of large markets perspective. The fact that you can solve this particular customer of theirs problem, useful. You can help them transform or gain more traction within a large market, interesting. And there's a big distinction here. And then the other element to it is, we'll, assuming that there's time, and I haven't totally bored you, we'll talk about what the expectations are based on stages of company and how that might reflect to you. How these different constituents look at you if you're seed versus your A versus your B. And they don't even necessarily use those terms, but they tend to fit within these strata. And the way these large corporations interact with portfolio companies, what I think of as portfolio companies or startups, is very much akin to where they are perceived by that partner within the strata. And then we'll talk about the venture capital Waltz very, very briefly, and the engagement pyramid, which I have built and is very successful from a venture fundraising perspective. But it really, you'll find, is very similar and is very, very useful for partner selection and key customer selection. And then I will do my best. I got the clock ticking here to leave aside some time for QA at the back end. Thoughts, questions, witty remarks so far? Witty remarks are greatly appreciated. Okay, so first of all, do what I say, not what I do. The worst thing you can do in a slide deck is have way too much text. We all know that. This is a text-heavy deck for very deliberate purposes. My expectation is that these slides will be made available to you, and my goal is that these become breadcrumb trails for you individually based on your company needs or evolution, et cetera. Might use this as a start point and a check-in point for your own further research. So my goal today is to rattle cages and get you some ideas of what the expectation set is for the Valley, and then give you some trails that you can either challenge the mentors and challenge the advisors that Terry has brought on board, or for your own benefit, continue that activity. So let's talk about the success in Silicon Valley. Again, investor bias, go to market orientation. First of all, getting to yes, whether it is a venture fund, an angel, a key customer, or a partner, it's a process, not a destination, especially if you're early stage. And this has to do with a couple things. First, there's the test of time. So every investor and every partner is going to want to know that you're going to be around for a while. We're coming to ABC, right? Always be closing. Get it, get it, get it. But the other side of that equation is thinking, are you going to be here not just in 6 months, not just in 18 months, especially when you're dealing with commercial partners and commercial deals? Part of their mission set, for those of you who've transitioned out of large companies know this, they're very concerned that if they engage with you, that you're going to be around in 3 to 5 to 7 years, because the amount of brain damage they have to go through and the perceived risk they have to go through to engage you and engage your solution into their business is one that they want to know they can amortize over the long term. So their incentive, therefore, to slow walk this, whether they consciously know it or not, they're incentivized to get a feel for how it is that you're going to navigate and what the growth trajectory of your business is, because that jumping ahead helps them with their risk profile. So is there a technology risk within your business? Are you able to deliver against what it is you're saying that your product or service can do? Is there a execution risk? Are you actually going to be able to do, the technology may work, but can your company actually navigate through the insanity of trying to work with a $100 billion company, work with a $2 billion company, work with a $100 million company? These are large organizations and you're having a big impact, but they've got so many internal distractions. Do you have the patience and the resources to help them get past their own barriers to be able to integrate the solution you provide? And then the last one is, believe it or not, market risk. So is there a large enough market, and are you going to be successful enough, not just with me? Because let's get to one other aspect of it. If you have one company, and I see this a lot, you have one company that owns 50% of your revenue flows, 60% of your revenue flows, all of that other money is nice. You're captive to that one company. And in the beginning, the customer in this regard feels, hey, this is great. You're going to be incentivized to save me and make sure that you are serving my needs. But that actually has an inherent risk in there. If there is not a large enough market, if there's not a large enough growth trajectory in your revenues, how do I know that you're going to be around long enough without having to come to me and say, hey, I know you're addicted to me now. You love my platform, but my cash flows are low. So we've got to renegotiate this just so I can keep my cash flows going so I can continue to serve this. This is not a pleasant place for your customer to be in. You, of course, don't want to be in that place. So they're also incented, as much as they want you to be addicted to them as a customer and serving them as a customer, they want to know that there's a large enough revenue stream and growing revenue stream for you that you're going to be able to continue to serve them for the longer term. That in turn feeds into the next piece. You can't do the one, you can't grow that revenue and see that revenue growing on an incremental basis without at some point crossing over into scaling. How is it that your business is going to achieve scale? How is your business going to then operate as a scaling business? From a commercial real estate standpoint, how does this in turn affect the way you can navigate if you're an enterprise company and you're selling into enterprises? How is it that you're scaling your operations and scaling your solution so that you are navigating across my control surface, across my organizational surface? What is your approach to this? If you're a company that has a long history of working with a point solution, what is the evolution going to be necessary? How is it you're demonstrating the ability to evolve into that broader spectrum solution into the company? Everything I just described is exactly how investors are also looking. So now what the investor is looking to do is, what are the proof points of everything I just described on the customer level? What are the proof points that you're delivering against this, which in turn de-risks the deal on the front end and demonstrates real meaningful growth opportunities on the back end of your success in terms of your go to market? Excuse me. The last piece to it is, it may seem somewhat counterintuitive, and I'm not saying that you start this anytime soon, nor do you bring it up deliberately, but you actually want to be thinking about what the logical scenario is for your exit. Let's go back to the earlier example. If the customer is saying that you are wanting you're comfortable with them owning 50% of your revenue, one of the scenarios could be is it's a buy to buy, right? They're buying your product with the idea at some point they just might want to buy your company. Now, what are the triggers that would force them into doing this? The other two things to think about this. First of all, if their idea is that I'm just going to buy you from the get-go, that's going to shape how they engage with you. That's going to change the dynamic I mentioned earlier in terms of having success within other customers. And also, I used a brief example of Intel. Intel created Intel Capital and were one of the first commercial venture funds which deliberately spun the fund out of the company. Yes, they're still inside. Yes, they still use a heck of a lot of resources inside of Intel, but they recognized early on that if they were going to be an ecosystem investor, then they needed to break the perception that the only thing they were doing was investing in companies to later buy them. Because the moment that word got out, it actually stifled the growth opportunity for those very portfolio companies to get other customers. Who wants to sign up for a long-term agreement with a company who's eventually going to become Intel? Now, if it's part of the supply chain and they want to do things because they're already tied into Intel, that's one thing. But what does that mean if you want to be AMD? What if that means if you want to be Qualcomm? What does that mean if you're going to be Micron, depending upon the solution set you're doing? This has a material impact on the perception of you as a company, and that in turn has an effect on your product. So understanding what your exit vehicle is should in turn shape the type of commercial the type of commercial engagements that you're going to be looking to foster. Am I looking to have you as a customer and an investor? That there needs to be a very strong rationale for that. Or am I purely looking for you as a growth vector for me? And then I'm going to serve the entire market. And perhaps at some point in the future, I will accept your capital into me as a business, but it's going to be part of a commercial consortium to prevent that perception of me being a further captive company. Okay. So one of the things I'm highlighting here is, sorry, I'm reading for a quick second.
Yeah, we have some questions.
Okay. So I'm going to go in buy to buy approach. So there's two things. So I'm going to get a little bit in the weeds, forgive me. So here's some techniques we should be aware of. And they're very similar, but they will be applied slightly differently. If I want someone to, so I'm going to put on a pure institutional venture hat for a minute. One of the techniques that I may do to get a sense of how much information I can extract from a company is I will test them and say, okay, so you're raising X amount of money. What if instead we were to raise 2X that? Maybe, why do you want to do a small round now? Why don't you in turn go for a larger round? And that oftentimes especially for a newer team, they will lean in and say, okay, this person's really in love with me. They see a huge value. They want to invest even more. And so they will in turn shift, without even realizing it, shift the amount of information they give and shift how they communicate about their company, looking to go after the bigger prize. Same thing that some of the more savvy, larger players will do is they'll talk about, well, if this really is important, at the end of the day, we're just going to want to buy you. It's just going to make a lot more sense for us to just incorporate you into the company than anything. Are they saying this because they're looking to get you to open up your information flows, open up the kimono more, or is it they're actually qualifying? So the big question back is, what are the qualifying questions you're going to engage with to determine the seriousness? As an example, if we start with hello, my name is, and then I do a product demo, and at the end of the product demo, I'm talking about maybe buying your company outright. Well, first thing is, have they done a calculation in their own mind? Let's just say we hit a home run. A calculation in their own mind, and they say, you know what? I love this company, and I'd rather buy them on the cheap now than pay the lease or the rent on the software over the long term. So if that's the case, now you know what the likely amount they're going to buy you for is. So the ceiling is usually, if it's that fast, the ceiling, if it's a pure product buy, product acquisition, asset acquisition, the ceiling is going to be, how is it that I amortize or reduce my cost versus actually having to support you long term? So just recognize that. That means you got a ceiling. The flip side to that is, all right, so what's the navigation where I am going to be, my acquisition of you as a company is going to be accretive to my business. So accretive means, how is it that when I bring you on board, it's not just the sum of the parts are greater, but the sum of the parts are greater and communicated and increased profitability. Increased profitability because I reduce my expenses, useful, very useful. Increased profitability because it expands my own revenue stream. It expands my market reach. I'm able to simply buy access into a revenue pool, much more interesting. So the first example is, how do I cost contain everything, including the purchase? The second example is, how do I forward project the shared revenue I'm going to be increasing because of this acquisition? How in the world do they have any gauge on that if they've just met each other? So if that latter strategy is the goal, that's a very good one. But that means we know going into this that we are going to want to engage into a commercial engagement to prove that the two of us together are able to make material money and able to grow and benefit each other independently and together. That's what's going to cause them. That's what's going to cause the CFO's office. That's what's going to cause the biz dev guys are easy. They're going to always be looking in to try and find ways to generate more value into the business. What you really want to do is get pushed over so that their sales organization, their CFO, and their operating folks, depending upon your platform, depending on what you're doing, are all seeing accretive value based on the way the two of you work together. I hope that makes sense. So it's have a strategy. If it's a buy to buy, understand that you're going to be looking at most likely 2 to 3 years. What you want to focus around is 2 to 3 years of shared revenue growth, which is really going to be demonstrating why it is they want to buy you long-term. And the other advantage of that long-term engagement. So by the way, 3 years for a large corporate is short, but the 3 years of spend is long for you. The more you can show, especially triple digit growth year over year, now we're shifting from an asset acquisition into an enterprise acquisition. Or in layman's term, how is it that I simply buy your assets at a cost plus basis or a cost minus basis? But what we really want to do is an enterprise where we're actually getting valuation based on future revenue growth. So you always want the latter. And also, and the last thing is you always want a bidding war. So if you're doing it with company A, you want to at least have two others with a total of three companies doing very similar things where you're showing how your shared value, your shared impact on the bottom line of them and yours. You want to have three of those companies. Is that way when one of them kicks off and says, hey, I'm really interested, that might trigger another person to get into it. You always want bidding wars to improve your valuation, improve what you're going to get. All right, I'm still not able to move things forward. Okay, so what are some of the core pillars? What are the core pillars here? So let's talk about this again. This is how does the VC ecosystem work, and let's apply this into our commercial engagements. So angel and seed, it's the key things we should take away from this. The amount of risk capital or risk resources which your counterpart is willing to put in. So the dollar signs, think of that as the easy part is just writing a check, but it's also the number of personnel they apply to it, the amount of resources, whether it's plant resources, assets, et cetera. What are the resources they're willing to put into the engagement with you based on the amount of perceived risk and value that you're creating? So when you're at the early stage and the early concepts, you should anticipate that your customers, not only they're writing a check, but the customers are also allocating resources in addition to that, that spend they're doing with you in order to gain value. They're going to have much more resistance, much more hesitancy to fully lean in unless there's something about your solution that is absolutely transformative and immediately demonstratable. We all know this. The customer has to learn this. As we progress through the stages of the company, what's happening is we are further refining our product, further refining how our product impacts our customer, further identifying the metrics that are being changed, the behavior changes within the company, behavior changes within the users that are reinforcing those metrics, that are demonstrating the value loop of the product that you're making, which is in turn enabling you and your customer to have value for value conversations, value ladder conversations about the impact of your product. As you have more clarity on that, and you have more metrics that you're communicating back to the customer, and better yet, that the customer is communicating to themselves, and best of all, that the customer is informing you of, right? The success story is when the customer says, hey, look at all this other stuff that I did because of you. That's exactly the type of testimonial, and what you want is repeatability of those type of testimonials, because that's demonstrating product market fit. That's demonstrating stickiness. That's demonstrating lean in, more and more lean into the customer. You'll see more and more of that as you go around this loop. Increased sophistication of the product, increased understanding of the value ladder, increased connectivity and ability to metric what that's being shown to that customer, which creates a nice reinforcement loop. And the late stage VC, so essentially at the expansion and the late stage, you'll notice a lot of companies are hitting that stage because their own customers start becoming their best marketeers. Their customers are literally telling their competitors, you're an idiot for not using this. That sounds crazy, but that actually is a defined metric you should be looking to get into. How is it that someone's bragging about how they're an industry leader because they're leveraging your solution compared to the laggards that they're running around? That is a real indication of not just product market fit, but demand pull into your organization. And what you'll then find is other companies are starting to say, hey, so A company is working with you and B company is working with you. What is it you do again? And they're already writing a bigger resource spend because they're saying these other people using this means there's value. These other organizations, not just that they're on the logo cloud, but they're actually incorporating you in some way and it's impacting their business. That's going to cause them to lean in further in terms of the resources they're willing to allocate. Switch that back up to the investor. The more you can communicate your metrics, the more you can communicate your revenue and your market adoption in these type of terms, it's strengthening the perceived value of your revenue streams. It's increasing the confidence in your product market fit. And as you get further along, it's demonstrating more and more demand pull where your spend is about conversion as much as it's about capture. I hope this is all making sense. Oops, am I going the right way? I'm going the wrong way. Forgive me. Here's the next one. I'm sure we're all familiar with the Gartner hype cycle, correct? So I want you to mentally overlay the last image with this one. So what this is talking about is, what is the adoption curve? So think about it from a risk profile. We know that what we're doing is materially and positively influencing our customers. We know that what we're doing is changing the way an industry is going to work. And so what we need to do is constantly find metrics that are transportable across customers and ultimately across industry vectors that start proving that out. And so this Gartner hype cycle has a direct tie to, it's cool and tech gets us on the beginning. It proves to have value is what gets us to the top of the curve. Because everyone's expecting it to solve global hunger and create flying cars, and they never do, then we're going to have a downstrike. So it's the idea here is these are very consistent from a pure technology adoption standpoint. These are very consistent activities that the market responds to your technology. So understanding these phases and understanding the impact it's going to have on your sales cycle, forward plan. What are the things we can do early on to minimize that trough? What are the things that we can do early on that are proving from the customer to itself that this is a friction they're working through? Because it could be that the friction isn't that the product isn't working. The friction isn't that it isn't hitting the bottom line. It could be, going back earlier, the friction is the customer needs to lean in more from a resource perspective to get the true value of what you're doing. Again, it's easier for us to say this because we built the product and we see the value. We still have to convince the customer that they're ultimately coming back to us and showing us how they're getting even more value than they expected. Again, this is the other last part here is, this is what you anticipate from a revenue or a market capture standpoint. You anticipate these type of, as from an investor perspective, you have that hyper adoption curve. And it's not that it goes down. It's not that yes, there's a churn piece to it, but the idea is that your growth rate is decreasing. You always have a steady growth rate, but your growth rate is decreasing through these pretty consistent trend lines. And if you are a multi-industry or a multi-vertical company or service, you should anticipate that you'll experience these independently of each other. This is probably the single most important slide I can give you for the entire deck. This is communicating those two slides earlier. The orange line is your anticipated revenue growth targets. In a traditional sense, this is breaking down from an investor standpoint when they tend to lean in and what they're tending to do in terms of their investment. What stage are you at? What is it they're willing to invest? And what is the expectation set they have at each stage of that investment? So we have a revenue at time. The valley of death, everyone goes through this. So this is the classic J curve. And the advantage of the J curve here is that it's saying I'm going to forward spend, drive myself down into the negative, but what am I getting for doing that? I'm getting faster market capture. I'm getting faster adoption from customers. I'm getting more insights into the product market fit and that demand pull. And I'm willing to do this to get ahead of my competition, or I'm willing to do this to get closer to a critical mass play. And so they're both in the same. Whoever gets in a lot of these deals, right? We've seen this. Who gets a large enough critical mass with a key set of customers is what causes other customers to then start again. Oh, they're doing this. Oh, they're doing that. So you may end up finding yourself doing multiple J curves depending upon your business and your industry. That in and of itself is not bad, but understand how that's setting us back from a time perspective, and therefore what is the value proposition for us willing to extend that accordion to get still greater returns. Excuse me. The next piece to this is, and we're going back to this very much. So I'm going to give you some specifics here. The original model was, we expect that crossover where you see the timeline and the red line goes over, that is traditionally CBE, cash flow break even. The idea is that our revenues have gone above our expense line around that time. And now what's happening is the way we're demonstrating scale is we're starting to see that separation between increasing revenues, even as we are maintaining or keeping our expense line shallow. That's a definition of scaling. Well, how is it we're proving that out? It's because we're reducing our CAC. or it's because we found more efficiencies in how we engage with customers from an adoption standpoint, or engage with customers from a spread, a land and expand if it's an enterprise type of. What are the things that we're learning from our operations? What are the things that we're learning from within our engagement with our customers that allowing us to cost contain our expense side, even as that empowers us to capture still more on the revenue side. So what ends up happening is each stage, each of these steps that you see is new capital infusion, which is doing two things. You don't invest for what was done. You don't invest today because of what you did last week. You invest today because it's a no-brainer of what you're going to achieve next week. And way that's important is I'm investing today, not because of proof points. The proof points are how I recognize the risk profile that what you're going to be able to do is execute your revenue ramp, execute your customer adoption ramp, which in turn means when you hit that next milestone, it's either going to make it a no-brainer for the next capital infusion, or it's going to encourage someone to start having that conversation about buy to buy. All right, what's the best way to qualify value of a cyber defense product that has preventing loss? I'm going to expand this out. So this isn't going to give you a specific answer. Security is a space that I personally play in. The good news about security in general is it's right. We all know it's a race to the bottom, and meaning that as soon as you create a better defense mechanism, someone's going to find a way to defeat it. So you always have an arms war, which is tremendous. It's terrible, but it's tremendous because there's always going to be that push to try and keep up with the arms war. So that's one piece to it. That makes it sound easy. No, it's how is it? This is regardless of whether you're an ag product, a cybersecurity product, a cyber defense product, or some other form of solution. How is it that your product is materially changing the behavior of your customer? How is it, the old adage of saving time, reducing expenses, reducing exposure risk? These are metrics that we want to look for, but actually there's a layer before that and a layer on top of that. How is it that because they have your product, it is enabling them and in reality, driving that customer's processes and behaviors to change for the better? How is it that that behavior change is opening up new possibilities for them? How is it, and maybe it is a matter of, it could be cost containment of I spend less money on insurance products to compensate for my loss, or I spend less money on restrictive data access solutions because I'm so afraid of getting penetrated, staying within the cyberspace piece. So what are the things, that's an easy one. But the other side to it is, how is it that what I'm doing and the processes and the behavior points and the metrics that we're changing is in turn leading to a cascading benefit for that customer? Why is it that changing this process and increasing the security in your example actually facilitates something else within the business that enables them to get still more value, right? So the easy one, going back, the easy one is we all used to use mail and then email came. It wasn't just a matter we didn't have to put stamps on and wait for things in the mail. How is it that email actually changed the behavior of business, changed the behavior of business units, changed the behavior of individual users? And how is it that that user profile change led to a whole cascade of other value? So if your solution is one that has a very targeted point, that in of itself doesn't mean it's a bad business. Well, let's just recognize there's a delta between I'm solving this piece and I contain the value creation in this piece versus I'm a small lever shaping a large market. Investors are always going to be biased towards small lever affecting a large market. We know it's a no-brainer. The email was actually a small lever comparably to a large market of the global mail system. And look at how much it's magically transformed things. So that is always going to compel the highest amount of investor interest and partner interest and customer interest. If we are on this side, then how is it that what we're doing is going to be very, very resource contained? Time, personnel, capital, benefit. the more we can quickly identify how we are affecting this piece of the overall customer involvement, and we scope ourselves accordingly, that's still incredibly valuable. That in and of itself might mean that we are the type of business that it's all about replicability across multiple industries that gets us that large industry effect, or we have such a large enough of benefit that someone else is feeling some acute pain and they're going to come in and overpay for us because they want that pain pill, because while it's maybe a limited scope product compared to their overall offering, it solves a key pain for them. They're going to very happily say, I'm going to put you into my overall mix. Your behavior change in turn makes it easier for them to adopt the other solutions we have. I'm going to overpay for you. So so you want to identify what are the metrics that can trigger back to customer behavior change driven by user behavior change, and how that sits on top of your value ladder. You cycle those things together, you're off to the races. And I recognize that what I just described is very simple. It's deliberatively simplistic, which in turn makes it hard. The good news is, especially if you're doing something new, you get to define what those metrics are. So especially in the early stages, you want to build the metrics that are in line with your value proposition, that are proving out your value proposition, so that no matter what, you win. Hope that makes sense. How am I doing on time? How am I doing on time?
You're good. You have half an hour.
Okay. Yeah, so I should have warned you all, if we do have a chance to work together at some point in the future, my portfolio companies, my client companies, it tends to be drinking from a fire hose. It is much more dialogue driven than what we're experiencing here. But again, if you retain 30%, good on you. The reason why this is so text heavy is I'm hoping there's some things that I covered today that trigger you for further research and engagement. All right, so on this, I'm not going to go into great tips. What I have here is broken down some common characteristics based on the type of seed stage. This was actually first created for a couple large international telecommunications companies, and also some manufacturing companies who were trying to understand how they know the word seed. They understand what Series A means. They've heard these terms. These are almost ubiquitous now, but it didn't mean it had any contextual relevance for their mid-tier economic buyers, for their upper scale economic buyers. And it definitely didn't help them have any sort of a risk profile when they thought about setting aside money to start a corporate fund. So what I look to try and do here is break down a couple things. Where is it traditionally you are as a product? Where is it that you're executing? What are the core drivers inside of the business? And what are the key elements to it here? A seed stage company, for most large companies, is very hard for them to engage with, because they can never truly get past that feeling of the risk paradigm, either associated with the level of maturity of the product or the level of maturity of the team. And I do not mean this in a de minimis or derogatory way at all. It's what they're looking for is COTS, consumer off the shelf. I install, it just works. I install, there's a maintenance contract, you take away some of the friction for me, it just works. Whereas seed stage is saying, no, you're taking a risk on this new process that is going to break your processes if it's successful, creating some additional friction because it's breaking those processes. But the net benefit to you is massively outweighing that. But it's a lean, mean fighting machine that's living on top ramen. So it's not going to have the type of resource depth. It's not going to have the type of longevity in the bank account to be able to deal with a customer who's suddenly say, yeah, this is mission critical for me. I'll get it in touch with you Q3 of next year. What? It's not going to have the legs for someone to say, yeah, let's do a proof of concept and get addicted to the proof of concept game and simply keep redoing the proof of concept. And so you're getting 50,000, 100,000 every quarter, which in one way, yay, money's good, but that's not helping you. You need to get those metrics I just talked about. You need to get that type of scaling function. Proof of concepts, especially repeatability, it's brain damage. It's brain damage. But for the large corporation, where's the impetus? Where's the driver for them? Also, let's talk a little bit about from an investor and what we're seeing in the Valley. So I'm going to take a sidestep. Folks often ask me, what is the min spec I need to be relevant to an institutional venture capitalist, or what is the min spec I need to be relevant to an investor? And oftentimes there's some similarities, very clear similarities between that and any mid to large size customer. What do I need to have? Well, it's been true for about 10 years now. In order for someone to take the meeting, if you're looking to be a late seed stage company, which means I've got a product, I've got revenues, I've got customers, I've got more than one customer, hopefully, and I've got the right type of metrics that are showing I know how to sell, I know who to sell to, and I have the beginnings of repeatability. That's about $1 million USD. It's about $1 million in net revenue, ARR, which had to get the conversation started. I've got a reasonable logo cloud. And the reason I say reasonable is it may be different based on your product set. For some, it's 3. For others, it's 5. For others, it's 30. If I'm a B2C play, it's different. In B2C, it's adoption rates. And while my numbers of zeros in my users is not as large as it needs to be, the point is the growth rate of that user pool is showing that I'm rapidly going to get to enough users to be of interest. So if you're B2B, it's easier because you've got a smaller target set, but it also means you got typically a longer sales cycle. If you're B2C, it's all about growth rates and adoption, baby. So you're trading one for the other. It's not automatically easier. That's to get you in the door. Right now, I'm seeing a lot of $2.5 million companies. I see a lot of companies where they're talking about ARR, and ARR is a roll up of their MRR. And what they're focusing on is MRR growth. And they're even at a late seeds company already starting to get some insights into their sales cycles so they can talk about number of touches, the reduction of the time. They're already talking about what their plans are to identify the key variables in their CAC and how they're reducing that CAC. Further, they're understanding how CAC is not just a cost of lead gen, but a cost from lead gen all the way through implementation and your initial renewal. So they're already at this early stage. These are topics which usually are your Series A discovery points to prove the A and beyond. Now we have enough competition out there that have this, that from an investor and a customer perspective, you can kind of wait to find those type of companies to engage with. So from a customer perspective, your resource allocation is de-risked because of the level of sophistication of the company. All right. So again, the next steps here, and I'm reading, okay, so cyber defense and education space, you two might actually want to talk on general terms with each other, because these are captive type of industry vectors. What I mean by that is the type of customer and the type of buyer, if I'm understanding what you mean by cyber defense, if we're talking about key infrastructure, large infrastructure, et cetera, just like education, they tend to be institutional. If you're selling to utilities, if you're selling into very large institutional players where there's large capital flows, but the growth rates tend to be somewhat structured. Or on the cyber defense side, it is now a built-in cost of the business, but there tends to be a lot more of a cost containment focus and a revenue growth focus. You actually are going to be finding similar types of challenges in how you navigate and penetrate those spaces. Furthermore, oftentimes, if it's you're selling any type of B2G, whether it's local, state, or federal, the good news about being successful in B2G is you get written in, right? You're getting written in, and then you've got these long-term contracts. Also, you've got some element of a premium, a profitability pre-programmed into it. They understand this. Downside of that is you're on their payment cycles, right? So your MRR growth is a lot harder unless you've found some way to price your things outside of the normal purchasing arrangements. And B, you're going to be contained by that. The good news is you got a built-in profitability. The bad news is you don't have that same automatic path to scalability that you need to really start showing this. So it's understanding the characteristics and how to a B or quasi B2G sale is different than your classic B2B. So you're going to want to identify metrics that can help people get past some of their own inertial problems. And also you're going to need to demonstrate how those metrics are still comparable and valuable when someone's looking at, do I invest or do I buy you, or do I buy a straight B2B type of play? So that's just a a piece of awareness. So let's talk about early stage, and I'm going to jump on the next ones too. So the key thing in early stage, right? So the old adage was late seed, you start the conversation around $1 million in revenue. That means that if I'm showing up with, I got a couple alpha customers. Oh, by the way, ARR is annual reoccurring revenue. That means you've got an agreement in place in which the customer has agreed to some type of subscription model with you, some type of reoccurring revenue generating model with you. The reason you earlier heard me talk about proof of concepts or proof of value, these are, by the way that the contracts are structured, these typically are one-offs, and they're typically built around the idea that the customer has the right to break or walk away at any time. That money is king. When you're early stage, money is king. Got it. Understood. But there's more than this, but there's two tiers of revenue quality. Revenue, which is POC, means I have the ability to get money in there, but there's no ability to forward forecast that you're going to collect that again, which is why folks who get trapped into the treadmill of repurposing POCs, the good news is, hey, they've paid me for the last 4 quarters. Why won't they pay for the next 40? Trouble is, by the very nature of the contract, that can stop at any time. So when a corporate who does a financial review on you, if part of the requirement and you're willing to share it is the type of revenue you're generating, or if they're analyzing your revenue based on the contract that you're presenting to them and see it's a bunch of POC revenues, what they're going to be thinking is at any time, this company's revenue can zero out. If you go to 100% churn, people simply choose not to renew or re-engage the POC, boom, we zero out. And now we got a problem of a company where they're relying on their solution, but the company can't survive. So understanding how your corporate, how your contracts are structured is very important. Understanding how your value ladder is leading and how the purchasing is leading to an automatic renewal, better still. So if you haven't already done it, I highly recommend, if you can get access to it, they publish it openly, especially if you're a SaaS related company, download the Salesforce contract. You're not going to be able to get that. Salesforce can make all kinds of demands. Your goal set is, how do I reverse engineer? And how do I demonstrate value into my market? And how do I build a large enough pool of customers and revenue that I can start to layer in more and more and more of these automatic renewals and automatic riders? Easy example is, you can sign up with, if you're an enterprise, you can sign up with Salesforce. They give you a bunch. If you go the route of paying up front, awesome, you paid them up front. And 2 months later, you say, this doesn't work, I'm done with this. The way the contract's written is, we're sorry to see you go. We'll turn the software off. Yeah, our money? No, that's ours. That's ours. The money's ours. You can choose to figure this out and spend the next 10 months making it worth your time, but that money's ours. So you've already sunk that money in. You want to get to that type of point, because that from a forward perspective, A, it's automatic renewal, and B, you've got to carve that out as opposed to us carving it from you. That power shift, that revenue shift, has a huge impact on the perceived quality of your revenues. All right. For the time I have left, so I'm just going to bounce through this and I'm going to kill the slides. So I see some more. I'm going to kill the slides after this. Growth and expansion stage. What am I doing here? The primary thing I'm doing in growth and expansion is I've moved. So this is product market fit. Early stage is demonstrating product market fit. And the way I'm doing that is the metrics that I've tracked earlier, and the type of contracts I've engaged, and the renewal of the contracts that I've engaged, and the expansion of the contracts that I've engaged. This, what I just described, is traditional Series B. It's now very common. Your competition is able to show, here's how I'm growing my ACV. Here's how I'm growing my TCV. ACV is annual contract value, total contract value, right? Those are 2 pieces into it. My counterpoint to that is, here's how I'm reducing my cost of sales. Here's how I'm reducing my CAC. So I'm growing my ACV within my current customer base. I'm reducing my churn, and I'm reducing my path to customers. Again, the reason why all of those numbers are happening is because that addiction paradigm, that value paradigm that the customer is getting in line with us, and our ability to deliver against that value is repeatable and consistent, and allowing the customer to grow their usage on an independent and a scalable way. Independent meaning they're not trapped for us to figure something out to help them grow. They're simply loading on more use of the platform, and therefore giving us more money because they're getting more value out of the platform, if you're a platform play, or a software play. Next element to it here, double-digit growth across multiple products, markets, and customers. So the key thing you're doing here is you're no longer just generating product market fit. You're actually demonstrating accelerated demand pull. Product market fit leads to demand pull. Product market fit is saying these customers are willing to brag about me because they're getting so much value. They're no longer willing. This is just part of your program. This is part of your community program. This is part of your outreach program. And now what you're doing is you're starting to move to the industries or the verticals to the left and right of you, and you're starting to layer in more products into your overall offering to extract still more value from your existing customers. The other thing, a way you know that folks are leaning into this is they're actually coming to you and wondering if there's other things you can do. And that doesn't mean they're asking you to become a consultant, because that's one of the things that's going on here, right? Everyone's going to, hey, can you build this feature? Can you build that? That's not what we're talking about. And we have to learn how to make sure we make that distinguishing element. What they're instead saying is, you do this well. Can you help me in this part of my business? Can you help me in this process stack? Can you help me modify these things? And now you actually can start to layer, and you have this decision. Do I build it myself to capture that? Or do I actually form a partnership with another solution that stacks on top of me or stacks with me that provides that larger holistic benefit that further expands my capture? This is my market capture, my growth within the customer. When you start having those type of conversations and you're brainstorming and building your roadmap around these type of things, that's really showing you you've moved into demand pull. By the way, your roadmap today, even if you're seed stage, have this in the back of your mind. What do I need to build today within my organization, within my systems that allow me to scale to that point and deliver against it? And the last part to it is, now the primary difference is just dominance. Now it's no longer, am I one of the players and people are bragging about me? It's now people are coming to me and asking how they can be in my ecosystem, how they can join my orbit. They're coming and saying, hey, what else can I do for you? So the conversations of partnerships are the same, but when I'm at this stage, the partners are now talking about long-term agreements and long-term contracts with revenue targets that are predefined that are large enough that it is shaping the trajectory of their revenues, impacting their stock value. You give me an extra $200,000 a year. Okay. All right. That helps me. You give me an extra $2 million a year. That could be interesting if I'm a $25 million a year business. You actually affect my trajectory of my own company, where I'm growing my own revenues by 2%, by 7%, by 10%. Now, all of a sudden, I'm incentivized to want to work with you. I'm incentivized to lean further into what you have to offer. So why is it that the two of us together enable me, E&Y, enable me, IBM, enable me, Yamaha, to say you plus me equals this type of growth? And therefore now I'm very interested in long-term arrangements and some sort of shared positioning within how the revenue flows and how the things go on. This also is your classic beginning example of, even though they may not be the folks who buy you, that data stack, that finance stack is exactly what your future buyer, if you choose to go that route, what that future buyer is going to be interested in to give you top dollar. They want to see that relationship across a minimum of 3 companies, There's the law of 3. So back here, I want 3 alpha customers who are addicted to me that I'm quickly turning into 5, quickly turning into 10, quickly turning into 20. Here, I want 3 logos who are actively bragging about me and saying I get value. Here, I want 3 logos minimum who are actually creating a demand pull and revenue growth within my overall stream. Here, I have 3 meaningful partnerships that are having an impact on the diversification of my revenue and the diversification of their revenue. Same concepts, but each one is a step function greater in terms of the impact and the expectation of that relationship. Okay. When we meet again, we'll talk about this. So if you go and talk to somebody and you're looking for capital, they're always different, but they tend to flow along these lines. And by the way, they do a similar type of thing on your large corporate engagements. And this is an approach on how you want to create the type of echo chamber, how you want to create the soft sell that then migrates into the hard sell of your next round, and how it is you create some demand pull and some FOMO within your own sales activities as it relates to investment. I'll end with this, and I'm going to stop sharing the screen so you're forced to look at my face. And that is, you sell your product, and the features of your product are what encourage your customers. The value ladder associated with those features that deliver the value of your overall product, that's what closes your customers. When you speak to investors, and in the future, when you're speaking to the C-suite, and you're speaking to the CFO, and you're speaking to the head of operations of a key customer who's going to write a very large contract with you, it's similar in this regard, in that now there's an elevation. The product becomes the given. The value of the product is a feature. The ability to scale that product becomes a feature. Your revenue streams are features. What you're selling is the shares of your company and the future growth of the value of those shares, which is predicated on how all of those features I just mentioned are on an upward scale. So you sell to your user the value of your offering. You sell to investors and you sell to large corporations the value that your company is going to be growing and scaling and dominant in the future, which de-risks the market, de-risks the execution, and is predicated on your ability to solve and deliver against your solution. Okay. This is some of the things we could talk about in our future. Thank you very much. I'm going to go back to the Q&A now. I want to thank you very much for your time. I dumped a heck of a lot of information on you all at once. What I'm hoping I've done at two things, I'm going to go into the questions, is I want to give you a sense of, there's the min spec, and we can talk about the min specs for each one of those stages of companies and what is necessary to be considered to be in that space and be attractive in that space. But what supersedes this is the competition that you are facing. It's the competition that you are against resources of other solutions that people are looking to try and sell into your same customers. It has to do with the metrics and the ability to demonstrate that product market fit and that demand pull that's going to really make you interesting to the investor set. And how the more you can overlap those two and overlap those two to these groups seamlessly, you're going to find yourself shifting from having to push water uphill and actually riding with the momentum. So that's the targets that I want you to shoot for. And the reason why I'm very, very supportive of what Thierry and the program is trying to do is too often meaning 95% of the time, portfolio companies come and they say, give me capital to produce, go to market, which proves why you gave me capital. And the problem with that is you're always one step behind. And so where I completely agree and support what Thierry is doing and other programs like this, you demonstrate to go to market, which creates your early organic growth, which turn makes you attractive to get that capital to accelerate that organic growth, to in turn further jumpstart your GTM. So Thierry has pulled together a really good team of people who are expensive. And one of the wonderful things that Canada is doing, and not many other countries do this, is they're not just putting folks out there and say, hey, just go on this junket, which is useful, but they're actually creating programs like this one where they're bringing together people who can really help you accelerate your activities. Putting together your pyramid for your corporate outreach is going to have a material impact here, and that you're going to start feeling that momentum going on. And I know it's easy for me to say and very, very, very hard to do as the CEO or the C-suite or the founder, but the best you can focus on GTM organic growth separated from your capital requirements, the better off you're going to be long-term. We fixate right now on our short-term cash flow problems. We're going to end up not realizing it, but become addicted to that paradigm. And there are types of investors who invest in this, but cash burn investment means that you're most likely going to be looking at people who want an annuity or want more and more control over growth, right? There's always a trade-off. What you want instead is that type of market dynamic that is leading folks to lean into what you have to offer, which gets you the opportunities for multiple interested parties, hopefully bidding wars, and then we're really off to the races. All right. What if you are so different in your offering and you don't have enough competition to validate the space you're creating and owning? Aha, the blue sky, blue water concept. So first of all, I will agree with you that especially if you are a small lever that's being disruptive, there was a time in the 60s where we had email. What? We had email in the 60s? Yes, we did. We had email in the 60s, but there was no real competition because the only people who had access to the grids and the networks where email would be relevant were mostly in academia or in DARPA related projects. The internet got started in the 60s. It wasn't called email, but there was this functionality. The reason I bring that up is it's may be that what the market that you're changing into has not yet realized. But don't think that there isn't competition, because at the very minimum, the competition is doing what you've always done. So then your competition who's solving and serving the old and busted way, they don't know it's old and busted yet, is still your competition, because in the mindset of the customer, at the very minimum, I do what I'm always doing, or I take a risk and do what you're saying. And further, if there isn't other people already doing this, where do I have that power of large markets? Where do I have that crowd? I can be part of the crowd as a way to emotionally de-risk what I'm expecting to do. So just recognize that if you don't have enough direct competition, it might be that we are not scoping what our direct competition is entirely, or we are so far out on a limb that we need to figure out how we pull back closer to the primary market while we lead them to where they need to go. So you could say Lyft is an entirely new way of doing things. You could say Airbnb is an entirely new way of doing things. Before Airbnb, which we now absolutely accept, there really wasn't anything like that. There was Expedia that was all about renting out or getting access, accelerating access to hotel rooms, right? The truth is, if you spent any time in Europe, and I think it's like this throughout most of the world, Europe and in particular Germany, after World War II, people would put up these signs, and it was beforehand, but it really became popular after World War II, that said Zimmer frei. And what that was is this was a person who had set aside a room and would offer you breakfast in the morning and give you that room, and you could come in and you would negotiate with them with the prices. It was usually pretty reasonable. You'd stay that night, you get breakfast the next morning, and you leave. When I was a kid, that was partially how we traveled through Austria, Germany, and Switzerland, was actually going to places and doing Zimmer frei. The only thing that Airbnb did is take an analog process, make it digital, and therefore make it much more accessible, and in so doing, disrupt two other industries. Minimum of two other industries, but it disrupted two other industries, hotel motel and the supply chain that was trying to automate the hotel motel booking system. It disintermediated both of those at the same time. Now they responded and they've adjusted. So my point is, if your concern is that you don't have clear, easy competition, expand what that means in terms of your market, and then figure out what the interim step or steps are to then migrate enough value and customer interest to that point.
That's good, Stewart, as always.
I think I've done my bit. We've cured insomnia. We have absolutely cured insomnia.
So if there's no other questions, we will see Stewart in about 2 weeks. Is that right, Stewart? Two weeks?
Is it that early? I think it's in November. It's in November.
Yeah. And that will be his second session on VC. The next session will be on Wednesday with Blaine Mathieu on go-to-market. So
can I put some stretch goals out for everyone in the program?
Yep, go for it.
So the program, as I understand it, stop with the qualifiers. The program is your success over this program now, and your ability to gain traction in the Valley is going to have a material impact on your attractiveness to the venture piece to this. So I'll restate what I said in the beginning. If you can, as much as the Valley is still pretty shut down, it is still pretty shut down, but you can still set up meetings. It isn't the way it was 2 years ago where literally, and it's true, you could get more done in a month. You could get more done in a week than you could get done in any other market in a month, any other top tier market in a month. It's the density and concentration is absolutely here. We also now have over 18 months of being much more useful and used to Zoom calls and social calls, meeting people for coffee, meeting in place. So if you want to have a business meeting, what I find is that if I'm going to have a formal business meeting, depending upon that, just folks get nervous about that. If instead you're going to meet people for a coffee or meet people for a lunch in a social environment, which in turn leads to some business conversation, that seems to be much, much more applicable. So the old set was, how do I get in your office, show you what I can do, run a demo, and get a close on a contract? Now what I'm seeing is, how do I connect with you, have Zoom meetings? How do I get to a point where I can engage as best I can in a virtual format? And then how do I solidify that by actually having some form of social, personal interaction? Because that still hasn't changed. Right, that ability to build that interpersonal bond, that ability to have that nonverbal communication is definitely happening. And the Valley it's informally open. It's formally closed, but it's informally open. So what should you be doing over the next weeks with the program that Terry's put together? How is it your ICP is driven by and driving your value proposition? How is your value proposition undergirding and driven by your pricing model? How is your pricing model and your go-to-market engagement to your customers defined? So that when you look at those things, what are the metrics that you can identify which are showing the shaping or changing of behavior within your customers? An example of that could be, how much data are they uploading into your platform and then transforming, processing, changing, et cetera? How many transactions are they running through your platform, or how many more transactions are they able to execute because of your product compared to what they were doing? Track these elements: usage, user activities, data. These are all important things, and the Valley loves data. So the way that you can communicate behavior change through data integration, it creates a nice feedback loop. It creates a very successful feedback loop. And I know a number of you are already starting to track these things. So if that's the case, what is it that you can do over the next 2 weeks, 2 months, 2 quarters, et cetera, that shows the net change in Delta in that regard? Those of you who are at the late seed stage, I actually recommend you monitor things on a week over week basis to do 1 month roll-ups, and then do things on a month over month basis. And then eventually, when you have a large enough traction and enough smoothing effect, you can then go from month to month to quarter over quarter. The reason being is you want to have as many metrics that you can highlight to your potential customers and or your potential investors that show that net change in state within your customer set, and therefore causes interest in what you're doing.
Thank you, Stewart. If there's no other questions, we will end this session, and I will be available if you have any questions via email. Please feel free to reach out. And I'll set up the Zoom call, not the Zoom call, the Slack channel immediately. Thank you, everyone. Thank you, Stewart.
Thank you all very much. If question again, now you can find me on LinkedIn. I know I fire hosed at you. I really missed out on the opportunity to meet with you and dialogue directly. I hope there's a chance to do that in the future. I am all ears. So any ways I can do things better, I'm very, very open to constructive criticism. If you end up being one of the future Googles or Airbnbs of the world, and you've got the proof points and the product market fit points, please do look me up.
Thank you, everyone. Thank you, Stewart.
Thank you.
Bye-bye.